A raft of data points coming out of the US in the week ahead. One of those will be the inflation gauge coming out on Tuesday. And I want to go through that, looking at exactly the direction of travel for inflation. Of course, the concerns around what tariffs might do to this and the implications when it comes to the likes of the US dollar, the likes of the S&P 500, and for gold. So first and foremost, this is the expectation for this release. According to Trading Economics, the expectation is 0.2 on the core figure for the month-on-month, 0.3 on the headline gauge. Aside from that, that takes the headline number up to 2.6 and the core number remaining at 2.8. Now, both of those numbers aren't necessarily too troublesome. They are elevated above 2%, the target, but they're not wildly away from it. So I guess the question mark is, are we likely to get back towards that 2% target, or are we bottoming out here and going to see a significant resurgence in price pressures? And that's one of the key themes that we have been seeing recently, because the University of Michigan inflation expectations figure has seen a sharp surge over both the 1 year and the 5 year inflation expectations metrics. Now, this is crucial because we're actually seeing these gauges in the week ahead as well. So keep an eye out for this on Friday. But this is sentiment, right? So sentiment doesn't necessarily mean the reality. And you don't necessarily know who's voting for this. Maybe it's the Democrats, maybe it's the Republicans. Generally, when you've seen a split in terms of the expectations for inflation, the Republicans don't think it's going to be a big problem. The Democrats think we're going to see a huge surge in terms of inflation. So this is sentiment, this is soft data, and we haven't necessarily seen soft data turn into hard data for a number of different metrics. In terms of the monthly inflation, what we have seen is actually disinflation to a large degree over the last month when it came to the headline number, the core headline, the core CPI, and the core PCE metrics. So is that the start of a new phase where in actual fact inflation drops out? Or are we going to see a resumption of the elevated levels of inflation that have been seen over much of the last, say, 8 months, as you can see here on this month-on-month inflation chart? So you can see here in terms of annual inflation, the trend still remains on a downward trajectory. We don't necessarily have a problem of inflation at the moment in terms of a turning upwards of inflation. Instead, we've got headline CPI 2.4, core CPI 2.8, core PC 2.65. Not necessarily problematic levels, and the kind of thing that could provide the Federal Reserve with the basis for them to ease over the course of the year ahead. But there's some hesitancy, and we've seen that with the FOMC. They decided to pause, but also they essentially led the markets down into a position where expectations for a June rate cut essentially got whittled away, and people are now looking towards July as the most likely next rate cut. Why is that happening? Well, of course, there's fears around how tariffs are going to impact prices within the US. Prices turning towards the upside alongside a deterioration in terms of the US economy. Well, there's a good chance that if that happens, you're likely to see the Federal Reserve still cut. But in the absence of a major downturn in terms of the US economy, a surge in terms of unemployment, then inflation, I think, will be an important one when it comes to the pathway for rates going forward. Notably, when we're talking about the sort of reflation, whilst we have seen it in terms of sentiment, we've seen that University of Michigan outlook for the 1 year and 5 year. We've also seen it in terms of three of the key manufacturing surveys. They are the Philly Fed manufacturing survey, the ISM manufacturing PMI, which we're looking at the prices paid element of that, and the Empire State manufacturing survey. So prices paid for all three of these, so essentially input prices, have surged markedly. That's not necessarily a surprise. Of course, when it comes to manufacturing, you're talking about the trading of goods. And so the companies involved here are going to be impacted heavily by 145% tariffs on China, 10% tariffs on the rest of the world, tariffs on different things, when it comes to autos and things like that coming into the country. So certainly inflation pressures have reared their head in certain parts of the economy. Is that going to really show up this time around? Because we haven't necessarily seen it massively over the course of the last month. Another element to be looking out for is inflation when seen through the lens of the headline number and being led by energy. Now, the thing that Donald Trump has tried to do to dampen inflation expectations is drive down energy prices. That's exactly what we have seen. A sharp decline in terms of WTI, and we can see that here. Now, I have shifted it by 1 month. So we've got WTI now leading by a month. And you can see here we've got this close correlation between the month-on-month change in terms of inflation and the direction of travel for oil prices. That points towards inflation coming in relatively low this time around in terms of the headline number. Now, markets are expecting, was it 0.3, I think. So, yeah, 0.3 is the expected figure. You know, maybe the energy effect sort of drives that a little bit lower. That remains to be seen. In terms of sort of the overview, the big picture, I guess, this is a chart that I often use. And essentially, you're looking at what's the direction of travel for the year on year? What's the direction of travel for the month on month? And you can see here for the month on month is 0.3 being stripped out from both the headline and the core. So that's the April from 2024 figure, 0.3 on the monthlies. So we need to be below that if we want to see inflation driven lower on the year-on-year figures. And as you see, the so-called base effects coming into play. Now, the 10-month annualized metrics, you can see here that core 3.1, headline 2.8, essentially. So there is an expectation that inflation and over the course of the next couple of months will actually rise from here. And so, you know, the question mark here is, you know, what's the implication in terms of markets? So here is my overview for the way that markets are reacting at the moment around expectations for rates versus different markets. So as you can see here, over the course of the last, let's say, 6, 7, 8 months, we have this close correlation between the probability of where interest rates will be by year end. That is the blue line. Then you've got gold, which I've inverted. So you've got an inverse correlation between those two. Then you've got the S&P 500, and you've got the US dollar. So essentially what we're looking for here is what's going to lead us down a pathway of thinking we're going to see more rate cuts in terms of the data, and what's going to lead us down a pathway of thinking we're going to see less rate cuts, right? Of course, if we see a sharp surge in terms of inflationary pressures, then that's the kind of thing that would make us think we're going to see less rate cuts. Now, bear in mind, of course, we've heard from the Federal Reserve, and what have they said? They've said, we've got a dual mandate. We have to look after the unemployment side of it, but also fearful of the inflationary effects. Now, we haven't necessarily seen a major deterioration in terms of the US economy at the moment. We have seen some weakness from some elements of the job numbers, like the JOLTS and the challengers numbers, but we haven't necessarily seen it in terms of the headline numbers. The ADP also came in relatively weak. But elsewhere, looking okay for the time being. So in the absence of any deterioration in terms of the economy, you know, if we see a surge in terms of inflation pressures, you know, then that's the kind of thing that markets might think that could make the Federal Reserve pause. If we see weakness in terms of inflation, then you're looking at additional rate cuts coming into play. Now, why would additional rate cuts coming into play and lower inflation lead to, as we see here, a weak S&P 500? Well, that's because by and large, weak inflation right now in this context would be taken as a sign that essentially there's a weak economy, right? So in the absence of weak GDP, or, you know, well, we have that, but there's a reason for that. Weakness in terms of the NFP or a rise in terms of unemployment. In the absence of that, weak inflation data has been seen as a sign of a weakening economy and weak demand, rather than anything to be celebrated, essentially. So essentially look at this release and look at the data that we see over the course of the week. And bear in mind, I've released a week ahead video as well, but look at it through the prism of how will this impact expectations for Federal Reserve action this year, going down the line. This next meeting, is June going to become live because of this data? And take a view on that. And then you can see this roadmap here to see exactly what would be a likely repercussion for the likes of the S&P 500, for the US dollar, for gold. You might not necessarily trade the dollar index, but you trade, say, dollar yen or euro dollar or cable or Aussie dollar cross. And so knowing where the US dollar is likely to move in these eventualities, then that gives you an idea of how those different currency crosses might play out. So let's just look at those charts and see how those three are currently shaping up. And of course, like I said, ultimately it comes down to how the data is released as to how what the impact's going to be on the market itself. So first and foremost, let's look at the US dollar. So this is dollar index. Now, dollar index has started to potentially find a bottom. This is something that I have been looking at on the monthly time frame and saying, well, if you look at it from this perspective, are we going to potentially start to see a little bit of a resurgence over the near term? You've got this sort of wider uptrend in play. Let's see if we've got a fib worth noting. So we've come into the 61.8 and then we've started to regain some ground. Now, it's notable that we've seen this massive deterioration over the course of 3 months. And a lot of that is coming down to this idea of like US exceptionalism is over. He's broken all of the rules. He's broken the relationships with all these countries around the world. Well, steadily, that theory is probably going to unwind to some degree as trade deals come through. I know that certainly the UK trade deal probably isn't the most difficult one to get across the line. But once we start to move into that phase, then that sort of story weakens a little bit. Nonetheless, if we're looking at a disproportionately larger move in terms of expectations of a rate cut from the Fed versus other central banks, let's say the ECB, it's about adjustments here. So essentially, over the course of the coming week, will we see the ECB, for example, because the dollar index is heavily weighted towards the euro, will we see expectations for the ECB adjust more towards additional rate cuts from the ECB? Or will we see additional rate cuts priced in for the FOMC? And it's relative between the two, and vice versa when it comes to a longer pause or a more patient approach from the central bank. And that ratio is then going to, you can plot it on your chart. You can plot, say, the likes of the Euro 10-year versus the US 10-year. And you can see these correlations yourself. So expectations around the Federal Reserve, how will that change going forward? Now, like I said, we've got this correlation which points towards if we expect additional rate cuts, you've got the possibility of this rolling over once again. At the moment, it looks like we're in sort of retracement mode potentially. Possibly a wider retracement coming into play. You can see here that we do generally see these pretty wide swings. So are we seeing a bottom here to come into a wider swing? Are we coming into a short-term retracement and we've exited this phase and therefore that really long-term downtrend comes into play potentially? Different ways of looking at this. But certainly as it stands, we're seeing the US dollar coming into a little bit more strength. We're holding off on those expectations of rampant easing from the FOMC after that latest meeting. This data is going to inform us even more. So, like I said, if we expect after this data additional rate cuts, it points towards this market rolling over, the US dollar rolling over, and that means upside for cable or euro dollar and the like. But if we see the likes of the data coming out to the point where we'd be expecting to see a patient approach from the Federal Reserve, then again, further upside for the US dollar. Then we're looking at the likes of the S&P 500 from a long-term perspective. It's a great chart, right? And we've seen this big pullback, but look at that monthly candle, right? It's just been an incredible recovery. And now we're trying to really continue on that vein. Notably, we did see that announcement that the US and China were going to have discussions. And we didn't necessarily see a massive response to that. In my mind, that sort of made me think that markets have sort of priced in a lot of the sort of positivity and they need to see something relatively tangible. But we have seen some strength. A lot of that's being led by tech names at the moment. Like I said, we've got that relationship where the possibility of additional cuts would be negative for the S&P 500. And essentially that tells a story of if we expect that the US economy is deteriorating in a meaningful manner that's going to force the hand of the Fed to act more swiftly, then that would likely see the S&P roll over. Now, for the time being, I would say this is probably one to be playing on the, say, 4-hour chart where you're looking at this sort of creation of higher highs, higher lows, and you're just tagging those higher lows and making sure that we're maintaining that trend. As long as that trend's staying in play, then I'm happy to still remain bullish for this market. But once we start breaking through your first swing low, then it's a signal that we could start to roll over, and that could come in the form of data of weak inflation. That could come in the form of data coming out on the back end of the week, where we've got some of the other data points coming out of the US, and that comes in the form of, I believe it's industrial production and everything as well. So yeah, we've got industrial production, we've got the retail sales numbers, unemployment claims, Philly Fed manufacturing index, Empire State manufacturing index, a whole host of things coming out the back end of the week. So plenty to move this market over the course of the week. But certainly if we see more signs of additional easing, that's not necessarily good for equity markets right now. But the trend at the moment over this sort of intraday basis remains bullish for this recovery that's playing out right now. The thing is that given the risk to the US economy, if we don't see a breakthrough in terms of US-China, then, you know, the longer this plays out, the more likely it is that something does break. And finally, let's look at gold. Now, we're seeing 2 days of pretty significant downside coming into play at the moment. And, you know, if we were to say overlap that with, say, the S&P 500, so essentially what you're seeing here is, there you go. So we're looking here in terms of the S&P 500. If I put on the hourly time frame, you can see this correlation that's playing out at the moment. I've inverted the S&P 500. So essentially the strength of indices essentially dampens demand for gold, which is playing the role of the haven right now. If we were to see the likes of additional rate cuts coming into play in terms of market expectations, it would be good for gold, bad for equity markets in my mind. So yeah, one to be looking out for. Certainly has been a big outperformer. We have got the possibility that we're just retracing into support before we push higher once again. But, you know, a lot of this is going to be relatively data dependent and data driven. So do we see data coming out that signals that we're going to need more or less rate cuts going forward? And the inflation numbers and alongside many of those other figures coming out the back end of the week should inform us along those lines. Look out for support at the 61.8, which is 32.92, and the 76.4, which is 32.57 over the near term. So pulling back at the moment, but that's in line with the strength that we're seeing with equity markets. And that's not a guarantee that that's going to carry on. And certainly if we were to see weak inflation coming out and then a weakening of some of these key data points out of the US, that would likely start to see the S&P 500 rolling over to the benefit of gold. So a lot of data, and important data, because it's going to have significant implications across the board, across assets when it comes to the S&P 500, when it comes to the likes of the gold and the likes of the US dollar. So I hope this has been useful. Make sure to like, subscribe and follow for more. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day.